If you look at the stock market lately, it really feels like it's become a one-trick pony, doesn't it? As we're cruising through 2026, the S&P 500 isn't just a broad snapshot of the economy anymore. It's become this massive concentrated bet on artificial intelligence. So the big question on everyone's mind is, are we standing at the entrance of a gold mine, or are we staring right off the edge of a cliff?
I mean, just look at this number. In 2025, over half, 53% of the entire market's gains came from just 5 companies. You can probably guess which ones. This isn't just some passing trend, it's a massive shift. The entire index is now hooked on silicon, with its future tied to just a handful of AI leaders.
So yeah, that's the big debate, isn't it? We're talking about over $500 billion in AI-related spending projected for this year alone. Are we watching the birth of a whole new economic era? Or is this just the dot-com bubble all over again, just in a new outfit? The stakes, well, they really couldn't be any higher. To get to the bottom of this, we're going to break down both sides of the argument, using the absolute latest analysis from Wall Street. And by the way, this deep dive is brought to you by QuickFlix by LinkTech, who make it super easy to get up to speed on complex topics just like this one. All right, let's dive right in. First up, let's hear from the optimists. This is the argument that the AI boom is built on a foundation of solid rock, not sand. What's so fascinating here is the fundamental difference between then and now. Back in '99, you had companies burning through cash, fueled by debt, and basically selling promises. But today's AI titans, the so-called hyperscalers like Microsoft and Google, they're funding all this growth from their own record-breaking profits. They aren't selling dreams, they're selling some of the most profitable infrastructure in human history.
And if you look at history, we might still be in the pretty early innings here. This chart shows current AI spending is only about 1% of US GDP. Now, compare that to other huge technological revolutions, railroads, electricity. They peaked at 2 to 5%. This suggests we're still in what you'd call the installation phase, with plenty of room to grow before we hit that peak euphoria.
And look, this rally is backed by actual, real money. Analysts are projecting some seriously robust earnings growth for the S&P 500 this year, and it's all being driven by this relentless, tangible demand for AI chips and cloud services. This isn't just hype, it's hitting the bottom line. Okay, but we all know every gold rush has its dangers. So now let's flip the coin and look at the case for the bubble, because there are some very real risks out there that are making even seasoned investors lose a little sleep. And this right here is a huge one. Analysts are calling it the productivity paradox. While spending on AI is just exploding, a recent MIT study found that a staggering 95% of organizations have yet to see any measurable return on that investment. So companies are buying the shovels, but almost nobody is actually finding gold yet. How long can that really last? Then you've got the sheer concentration of it all. I mean, with over 40% of the market's value locked up in just 10 names, the whole system is kind of brittle. If just one of these giants slows down its AI spending or, heaven forbid, misses an earnings target, you could see a domino effect, a coordinated decline that could pull the whole market down with it. And this might just be the biggest hurdle of all. The real bottleneck for AI is shifting from silicon chips to the electrical grid. Look at the chart on the left. Data center power demand is just going vertical. Meanwhile, the chart on the right shows the US is actually facing declining spare power capacity. AI is incredibly energy hungry, and that physical constraint could put a very hard ceiling on growth. So what is it? A bubble or a gold mine? Well, the truth, as it often is probably a bit more nuanced. Instead of a simple boom or bust, a lot of analysts are seeing 2026 as the year of a great rotation, where the very nature of the AI investment starts to change. Here's how they see it playing out, kind of like a 3-act play. Act 1 was the past, all about the hardware, the shovels, think NVIDIA. Right now, we're in Act 2, focused on the cloud platforms building out the infrastructure. But the future, the true gold mine, is Act 3. That's when regular, non-tech companies in healthcare, finance, manufacturing start using AI to slash costs and drive real productivity. That's the rotation everyone's watching for. So what does this all actually mean for you? Instead of just picking a side, bubble or gold mine, experts are focused on a few key signals that are going to tell us which way the wind is really blowing. So here's the bubble sign to watch: unsustainable capex. Basically, if that total spending on AI infrastructure gets close to $700 billion without a big corresponding jump in what companies are making from software revenue, that's a major red flag. It would mean the spending is getting way, way too far ahead of the actual value being created.
On the flip side, here is the ultimate green light for the gold mine theory: jobless growth. It sounds a little strange, right? But think of it this way. It's a scenario where the whole economy, the GDP, is growing a lot, but labor costs aren't. That would be the clearest signal possible that AI is creating massive economic value, that true productivity gains are finally here.
So ultimately, the question for 2026 might not be whether to bet for or against AI. The revolution is already here. The real question is, who's going to capture the benefits? As the market shifts from building AI to actually using it, we're going to see a new divide emerge between the companies that successfully harness it, the haves, and those that get left behind.